All right, the signal from SEOUL is locked, no preamble, let's get straight to the data. Okay, the critical data point just dropped, and it is a big one. A historic negative 3.3 trillion Korean won net sell-off by foreign capital just slammed the South Korean market. Now, this is not just noise. This is a direct vector signal, and it's aimed squarely at the U.S. Open. Make no mistake, this massive capital flight is a clear warning shot. The smart money is making a move, and that vector is pointed directly at the heart of big tech's supply chain. We have to understand exactly why this is happening before Wall Street even thinks about its morning coffee.
What we're witnessing here is a highly targeted red signal coming out of SEOUL. This isn't some broad market panic, not at all. It's a calculated, almost surgical reevaluation of the entire AI hardware supply chain. And the first domino just fell in Korea. So this brings us to the absolute core of the issue. Why is this happening now? It's because the old market rules, the old playbook, it's obsolete. We are now operating under a brand new principle that explains this massive capital outflow. We're calling it the liability of demand. You need to burn this into your brain because it is the absolute core of tonight's strategy. Liability of demand. It's what happens when a buyer's huge CapEx promise, the big flashy announcements from a company like Amazon, transforms from what used to be guaranteed revenue into a massive ticking time bomb on the supplier's balance sheet. The game has fundamentally changed. And this slide, it lays out the dynamic perfectly. On one side, you've got Amazon's planned $200 billion CapEx spend. Sounds amazing, right? But on the other side, you see their free cash flow just cratered by 70%. Now, that financial pressure doesn't just disappear into thin air. It gets exported, pushed directly onto their strategic tech partners, like Samsung. The buyer's cash problem becomes the supplier's balance sheet crisis. So, how does this transfer of risk actually work? How does big tech effectively export its financial pain right down the supply chain? Well, it's not magic. There are three structural mechanisms at play. Let's break down the mechanism. First, you have asymmetric risk. The supplier, let's say Samsung, has to invest billions in cold, hard cash right now to build out factory capacity. The buyer, Amazon, on the other hand, they can cancel that massive order at any time. All the risk is on one side. Second, we have the ROI dead cross. When big tech's cushy software revenue growth starts to slow, they need to protect their own margins. And how do they do that? By turning around and demanding aggressive, brutal price cuts on the hardware they buy. And that brings us to the third point, which is a new market focus. The game has changed. The market no longer rewards sheer volume. It's now all about pricing power, your ability to defend your margins against a customer who is trying to squeeze you. This is the new valuation model. Plain and simple. Forget who has the biggest order book. The only question that matters now is pricing power. Can a company defend its profitability when its biggest customer is under immense financial pressure? That is what separates the winners from the losers in this new era. Which brings us to the key question for tonight's U.S. session. Can a leader, a titan like Nvidia, actually decouple from the gravitational pull of its biggest customers, like Amazon? Or is this supply chain pressure going to pull everyone down together? The answer is going to set the tone for the rest of the year. Okay, let's move from analysis to execution. The vector is locked, and the critical level for the Nasdaq 100 has been identified. All eyes need to be on this number. Now, before the market even opens, we have a high-impact data trigger. It's the U.S. non-farm payrolls report, and it drops at 8:30 a.m. Eastern. This number is going to dictate the Fed's next move on interest rates, and it could either pour gasoline on this bearish fire from Asia or completely put it out. So here is your execution guide. It's a binary event. If that number comes in hot, let's say over 100,000 jobs, that's bad news for tech. It suggests rate cuts are delayed. We'll be looking for a breakdown towards 24,400. But if it comes in cool, under 50,000, that's bullish. It suggests the economy is cooling off. Then we can anticipate a potential rebound towards 24,900. You need to have a plan ready for both outcomes. And this right here is the line in the sand. 24,700 on the Nasdaq 100 futures. The NFP data is going to force a decision right at this level. If it holds, it means the SOL signal was contained. But if it breaks, a break confirms the bearish trend shift for U.S. tech has officially begun.
So here is your action checklist. For Amazon, the opening price is your pivot. For Nvidia, you're watching the previous session's low like a hawk. But the master key for the whole market is the QQQ. If it holds that 24,700 level, the bull case stays alive. If it breaks, the trend shifts bearish, and the signal we got from Asia is confirmed.
So the key takeaway tonight is this. The old rule of follow the CapEx is dead. It's over. The new rule is follow the pricing power. So before the US Open, I want you to run this analysis on your own portfolio. Who is insulated and who is exposed to the liability of demand? Because right now, that is the only question that matters.